So analyzing financial statements. And when we are looking at analyzing financial statement, we shall be covering two items for analyzing financial statements or financial statements analysis. It normally encompasses the cash flow, means cash flow statements, or you can write. It encompasses the cash flow statement, and number two, ratio analysis. So those are the two items under the analyzing financial statement. So write that and say that it includes the analysis. Includes the analysis of financial statement using number one, statement of cash flows, and number two, ratio analysis. Statement of cash flows, and the second one is ratio analysis. So we start with the first one, cash flow statements. Or statement of cash flow. Statements of cash flow. That one is IAS number 7. International Accounting Standard number 7. We shall say that this is a statement that shows the cash flow, the cash inflow. A statement that shows the cash inflow and the cash outflow. A statement that shows the cash inflow and cash outflow in one financial year. Cash inflow and cash outflow in one financial year. Cash refers to liquid cash. Cash refers to liquid cash or cash at bank. Liquid cash or cash at bank. While cash equivalent refers to short-term investment. Short-term investments which can easily be converted into liquid cash. Full stop. They are also called near cash. Near cash money. Another statement. IAS number 7, International Accounting Standard 7, requires a cash flow statement to be classified. Into three categories. Number one, cash flow from operating activities. Write that. It refers to the transactions. Relating to the main business activities. Of the firm. Transactions relating to the main business activities of the firm. These transactions are included in the income statement. These transactions are included in the income statement. Number two, cash flow from investing activities. Cash flow from investing activities. Cash flow from investing activities. Shall we say, investing activities refers to transactions. Investing activities refers to transactions relating to purchase or sale, of fixed asset, and investment income. They also include transactions relating to disposal of assets. Number three, cash flow from financing activity. These are transactions that are used to change the size, and composition of capital. Capital structure of a company. They include the cash received from issue of shares, dividends paid, interest paid, acquisition of loans, and also repayment of loans. Full stop. So those are the three categories or three classifications of cash: cash flow from operating, cash flow from investing, and cash flow from financing activities. We look at the importance of cash flow statement. To a business enterprise. Number one, it shows the real liquidity position of an enterprise. Number two, it shows the ability of an enterprise. To pay short-term. Maturing obligation. As and when they fall due. as and when they fall due. And number 3, it indicates the ability of an enterprise. It indicates the ability of an enterprise to pay cash dividends. It indicates the ability of an enterprise to pay cash dividends, to its shareholders. Pay cash dividends to its shareholders. The other one, it is an important tool. It is an important tool in cash management. An important tool in cash management of an enterprise. Cash management of an enterprise. And the other one, it indicates the main sources of cash. It indicates the main sources of cash for an enterprise. Main sources of cash for an enterprise. And the last one, it is important for working capital management. It is important for working capital management. Remember, when we talk about the working capital, we talk about the current assets minus current liability. The amount that we normally use to finance the operations. Generally, when you look at the cash flow statement, we normally say it's a reconciliation statement. It normally reconciles the cash at the beginning and the cash at the end. We are reconciling these so that we can show the movement of cash during a particular period. So during the year we may have transactions 1 million, maybe 2.4, but at the opening we had maybe 200,000, and the closing we have only maybe 15,000. So it is a cash flow statement that will explain why we have that particular difference in the opening and the closing, whereas we are showing we had a lot of cash flow movement during the year. So it will be able to reconcile. The way we are doing the cash book, the reconciliation of cash book, bank reconciliation, so the same thing. So the cash flow statement will be reconciling the amount of cash at the beginning and the amount of cash at the end. And remember, when you talk about the cash, we are talking about both cash and bank, and also the cash equivalent. So the cash equivalent in this case will mean things like the treasury bills, and treasury bills, short term, 90 days. That within 90 days they can be converted into liquid cash. Treasury bills and short-term investments. So this one will be termed as cash equivalent, the one that we are calling near cash, because within a period of 3 months you can convert these two into a cash. So look at the format of statement of cash flow. This is format of statement of cash flow. The same we are categorizing into 3. We start with the cash flows from operating activities, or let me just call it operating activity. Operating activities. Now let's start with the profit before tax. We adjust that with finance cost. Depreciation. Finance cost, depreciation. If there was any impairment of the intangible, loss on disposal of asset, Then you have the gain on disposal of asset. Any gain we minus investment income. Investment income again we minus. We shall do what we call reclassification. This one gives us the cash flow. Cash flow before working capital. Working capital. Then you look at the working capital. In the working capital, you look at the increase in current asset. Increase in current asset. You minus decrease in current asset. Decrease in current asset you add. Increase in current liability. You add and you decrease in current liability. You minus and you get cash flow before tax. Cash flow before tax. You have the tax paid. Where the cash flow from? Net cash flow from operating activities. Net cash flow from operating activities. Number 2, we have investing activities. And we have the disposal proceeds of assets, the assets that we sell. Then we have investment income. Then we have acquisition. Acquisition of PPE. Let me just call it acquisition of asset. And acquisition of intangible. So acquisition of PPE and acquisition of intangible asset. So the acquisition, remember, is an outflow. The one that we're putting negative is an outflow. Yeah, outflow. You get the cash flow, net cash flow from investing activities. And number 3 is financing activities. You have the issue of shares. There is any cash you receive from the issue of shares. Dividend paid. Then the payment of loan. Then acquisition of loan. And we have repayment of lease obligation. Payment of lease obligation. We have the finance cost. This is interest. When you talk about the finance cost, where the cash flow. Cash flow from financing activities. So the cash flow from financing activities. And you get what we call the cash flow for the year. the year. Then opening cash and cash equivalent. We have closing cash and cash equivalent. And call this our A, this is my B, this is my C. So the cash flow for the year, this is A plus B plus C. Okay. That is our statement of cash flow, showing the three parts. But under the operating, we have a mini part that is dealing with the working capital. Because under current asset, we normally have what? The cash, and we have the bank. These two will be our balancing figure here. At the end, the one that we are calling cash and cash equivalent. These two will be the balancing figure at that particular end. So here is only inventory, receivable, and payable. So when you talk about the finance cost here, this one will be dealing with interest. The interest paid. The interest paid. And the reason we are adding these items that we are having here, we are adjusting. These are adjusting the profit before tax. There are some items that were deducted as expenses, especially the finance cost. It was deducted as part of what? Operating, but it's not an operating activity, it is a financing activity. So we are just doing what we call a reclassification. We are removing it here and coming and deducting it here. It was deducted in the income statement, here we add it back, we come and deduct it. When we talk about this one, depreciation and impairment, remember this one is non-cash expense. Non-cash in that when we depreciate an asset, actually we don't set money aside. That this money is for depreciation. We don't have a depreciation account that we are depositing money. It's only for accounting purposes in order to compensate. Ideally, we should put money aside, so that when the useful life of the asset is reached, we are able to use the money to buy another asset. But because that is not the case, we are adding it back because we are only dealing with what? The cash flows. So these are not a cash flow, and this one is not a cash flow, so we are adding it back. So the laws on disposal and the gain on disposal, we normally say these two, they are not in the cause of trading. So we are not in the business of disposing assets. So when you dispose an asset at a gain, that one is not a business gain, or it's not a business income. So that gain, remember we are preparing income statement and the other income. So the gain on disposal, we are adding it as an income, but it's not a business income. It's other part of incomes from other sources because our main activity is not to dispose asset. Therefore, the gain we shall be lessing. The loss, we normally put it as an expense, so we shall be adding back. The main aim of this part, remember, we are adjusting the profit before tax in order to get the actual activities that took place in the business in terms of cash. Then investment income is a reclassification from that point to this point. It is not an operating activity, it is an investing activity. So we got it as a result of investing. That's why we are reclassifying that amount to this particular part. So this part, we shall be dealing with these items. When we dispose of proceeds, when we sell, we get cash. So we shall be adding that. Investment income, acquisition of PPE we minus. So this negative is an outflow. Remember there are two types of cash. It is either a cash inflow or a cash outflow. So the negative is an outflow. The positive one is an inflow. Let me come here. When we talk about an increase in current asset, it's like inventory. When inventory increases, what happens to cash? When inventory increases, the cash decreases. Because the increase in inventory is as a result of purchasing more. You get that? You went to the shop and you purchased more inventory. And because of that, it is an outflow because we paid. Increase in receivable, these are debtors. We are selling on credit. So if debtors increases, assuming we had debtors of 2,000 at the beginning, maybe this is 2020, and 2021, the debtors increases to 4,000. So they has increased by what? 2,000. Is it an inflow or an outflow? Yes? Inflow. Why? Is cash increasing or decreasing? Remember, we are selling on credit. We are selling on credit. So they took goods valued at 2,000 and they did not pay. So they went with our money in form of goods. So when debtors increases, it is an outflow. When debtors decreases, it is an inflow because they are paying us. So the result of debtors decreasing, they are paying us. The argument here for current liability in terms of payable. When the payable increases, assuming now this is payable, 2021, we had a payable of 4,000. 2022, we have a payable of 8 or 7.5. It has increased by 5. So an increase in payable, is it an inflow or an outflow?
An inflow.
An inflow. Why?
We've taken from them.
Yeah, so we have bought goods from them on credit. When those goods come into our business, what do? We sell them. We get cash. But that cash, we retain it. We have not paid them. So it's an inflow. Increase in payable is an inflow. But whenever it decreases, it means we have paid. So it becomes an outflow. So hoping you have gotten that concept. So don't get confused here when you talk about an increase and a decrease. So this part, shares. When shares increases, we are getting money because we have issued more shares to the public or to our shareholders. When we pay dividend, it's an outflow. When we repay loan, it is an outflow. When we acquire loan, that one is wrong now. When we acquire loan, it's an inflow. Change that. When we acquire loan, it is an inflow. Acquisition of loan. It doesn't have bracket for the acquisition of loan. That is an inflow. Repayment of lease. Lease obligation means that sometimes we lease the asset instead of buying in cash. When we lease, we shall be making periodic payment. Those periodic payments will be an outflow. And after that, we shall now be getting the cash flow for the year, which we are adding the net from operating, the net from investing, and the net from financing. We get the net cash flow during the year, we add the opening cash and cash equivalent, and we compare. So remember these two. When you take this plus this, you should get the end. It is a reconciliation statement. If this is positive, this is negative, when we minus, we are supposed to get this. It's the same thing in cash, the balance sheet, the financial position, the way it balances. So you will know whether you are correct or you are wrong, if it doesn't reconcile. So you have a t-shirt. So it must agree. When you add the opening plus the cash flow for the year, it should give you the closing cash flow.